Hello, I'm Christopher Heidel, and I'm the co-founder and chief investment officer for Heidel Beal & Associates, your independent financial advisory firm. And I'd like to thank you for taking time out of your busy schedule to join us today for this small video message and to hear our thoughts. It's June 30th, Monday, the end of the second quarter and the midpoint of the year. And as such, it gives us a chance to look back at what a remarkable first half year it's been. The year's been remarkable for the success of the Sochi Olympics, for the annexation of Crimea, and most importantly, it seems, for the remarkable resilience of the financial markets. Stumbling out of the gate early in the year in January, coming out of a terrible winter, and into a volatile, yet somewhat stable, growth rate for the financial markets. But importantly, and not to be lost on Heidel Beal & Associates and probably many of you, last week we saw a huge revision downward to the first quarter GDP numbers. Now, gross domestic product is one measure of the expansion of our economy, and that GDP number gets revised a few times, but this was a whopping decline of 2.9%. This negative growth rate, or contraction in the interest of plain speaking, argues for potential recessionary conditions. So, should you be worried that we're in a recessionary phase, or that a recession is just around the corner? Well, not to worry. The mainstream financial press and financial journalists of all stripes are all over it. And in a remarkable echo of last year, 2013, in which the headlines were dominated by weak, negative economic news, we're told simply to move on. There's nothing to see here. As just one example, a quote from a Mr. Neil Dutta, who is the chief economist at Renaissance Macro, interviewed in the Wall Street Journal, who says if GDP were truly so weak, we would not expect aggregate hours worked to climb by 3.7% annualized, jobless claims to remain near cycle lows, and consumer confidence to hit a cycle high. In fact, GDP is the outlier in these data points. I will just roll my eyes and move on. Now, don't you all feel better? And shouldn't you do the same? Well, at Heidel Beal & Associates, we don't think so. In fact, there are other data points that are lost in these numbers, and they shouldn't be. For example, the decline of 2.9% is in real GDP, adjusted for inflation. So what's the inflationary number that the Bureau of Economic Analysis, or BEA, uses in calculating GDP? Why, 1.27% is the inflation rate they used in calculating first quarter real GDP. But the Consumer Price Index measured first quarter inflation at 1.8, fully 0.5% higher, which would mean that GDP, adjusted for inflation, would be 0.5% lower. If we look at the Billion Prices Project at the Massachusetts Institute of Technology, we see that their inflationary measure for the first quarter was up 3.6%. Adjusting for the Billion Prices Project measure of inflation would push first quarter GDP on a real basis down to a negative 5.9%, nearly a negative 6%. This isn't meant to shock or alarm you. These weak data points we've been contending with for over a year. And in fact, intermittently since the so-called recovery began. Know that the future isn't to be feared, but it is to be planned for and to be prepared for. So what should you do with this information? Well, if you, like us, are skeptical, you should first seek the truth. And if you have a financial plan, make sure that you stick with it. And be sure, too, that it can accommodate these fluctuations in the economy. So how are we protecting our clients, like you? Well, to be sure, with the relentless rise in the stock market and the propaganda machine which continues to prop it up, it's been hard to find value. But there are points of value which are shaking loose around the world. In some emerging markets, like Russia, for example, prices for Russian oil companies are at low levels I've never seen in my entire investment career. Some of these types of investments, very low cost, inexpensive, high cash flow generating investments, are there for us. And We'd be foolish not to seize the opportunity. None of these come without risk, but some of these valuations are so compelling as to not be ignored. Other things which still we find favorable are gold and precious metals, which bounced last week to the best performance in over 3 months. Gold prices are now up over 10.6% for the year-to-date period, handily beating the stock market, which is up about 5.71%, as measured by the S&P 500, through the mid-year point. And Treasury bonds, which we feel still offer all of our clients a great measure of protection from monetary instability and any contraction in the economy, are up over 14% on regular treasuries and over 22% on zero-coupon bonds. These are some of the ways we're ready for any change the economy throws our way.